Are we sufficiently restrictive or not?
100%, absolutely, we are sufficiently restrictive.
So Williams over Dudley?
100%.
What tells you?
Well, this is the highest Fed funds rate since the 6.5% of 2000, when we were in the midst of the dot-com bubble. And even then, 6.5% was plenty strong enough to slow things down. So I think 5.25%, 5.5% is plenty strong. We're going to get core personal consumption expenditures in about 40 minutes or so. That should come in year over year around 2.7, 2.8. That's half of where it was a couple years ago. So things have slowed down a lot. You've got a very high real Fed funds rate. You look at the bottom half of businesses and households, they're slowing down. Don't listen to me, listen to Brian Moynihan, who was out yesterday saying, oh, goodness me, look at the slowdown that's occurring there.
How relevant do you think payrolls is next Friday? A week today, in about 40 minutes' time, we'll get that number. How relevant is that number?
I think the personal consumption expenditures number is very important, just so that we know the disinflationary trend is underway. We're not going to get that close to the 2% target, but we'll confirm that we're on that path. That's good enough. For the Fed to think about moving earlier, they're going to have to see more stress in the labor market. They're going to have to see unemployment start to go higher meaningfully. Think 4.2, 4.3%. We're a little bit away from that now, but that could change over the next few months.
Okay. You said, yes, definitely sufficiently restrictive. So then why haven't we seen more of a slowdown as of yet? Why have we been surprised consistently by how hot inflation has come in and, frankly, how strong growth is?
Because there's a lot of money still sloshing around in the system from all the fiscal transfers that have occurred during the pandemic. And that just takes time to work its way through. But it is. And you are seeing the pressure on the bottom half of income earners. They're putting more on credit. They're cutting back purchases across the board. Maybe they're still trying to get in a bit more of spending on services, travel and leisure in particular. That probably starts to slow down over the summer. There is sticker shock in prices, and you are seeing the stress in businesses. When you look at small and middle market corporate America, that's where the amend and extend is occurring. That's where they are cutting back on CapEx.